You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Welcome to a daily edition of Talking Real Money, the podcast. I'm Don McDonald. And today we're going to do questions, but we're going to do written questions because we got a lot of written questions and not any called-in questions. So if you'd like to call in your questions, we love to get them that way or in writing. You can call us at 855-935-TALK 24 hours a day, 7 days a week, 855-935-8255. Or you can send the questions in via talkingrealmoney.com, the website. Hit the contact button, and we will try and answer as many of those as we can, as quickly as we can on this podcast. So we've got three. One of them's not really a question, so I'm not going to mess with it. But we've got three, and I'm going to start right now with one on Social Security, but it's not really on Social Security. You'll see. Social Security and an advisory fee question. Can you guys talk about a scenario where you took your Social Security at 62 and retired, but you had enough assets to kind of invest that money instead of spend it and see what the compounding and the gain would do in comparison to taking Social Security at a later date? My thoughts are at least you would have some assets for your family if something happened to you as you get older. Well, bear in mind, though, your family is going to get the higher benefit for you waiting on getting your Social Security. And the reason we don't suggest taking your money at 62 is because we don't know of a safe investment where you can get the kind of return that you get just leaving it with Social Security. Yeah, if you took some risk with it and the market behaved, you could very well end up with more money. But it's a risky scenario, and so in most cases, that's why we say it's just better to wait as long as you can, and if possible, wait until 70, which is where your benefits max out, if you can, if you believe you have the longevity for it. The second part of your question is, also, does your firm offer a service where you can come in one time and bill hourly for maybe some investing advice, and the client can go back and make the trades themselves if they chose to? Kind of a hybrid approach for someone who wanted occasional advice. I appreciate any time you can give to these two subjects. And yeah, we've looked at hourly fees. But one of the biggest problems we find with hourly fees is the lack of ongoing advice. That's why we just give you free advice on the radio, or you can call if you just want a one-time meeting with an advisor. You can go set up an appointment at talkingrealmoney.com. We'll talk to you one time for free. And we don't try to sell you anything. But the reason we believe you need the ongoing service and the reason we priced ours so low for full-service advice is because we believe that the biggest part of our service, the most valuable part of a fee-only 100% ongoing fiduciary investment advisor is not the picking of the investments. That's not the hard part. That's easy. We can give you those on the radio. The most, and Vanguard found this to be the same. The most valuable service we can provide is the ongoing guidance. Part of which includes rebalancing, part of which includes reevaluating your situation, part of which includes reevaluating your risk tolerance and risk needs. They both have to be factored in, along with all the other stuff that comes up. So that's why we think an AUM, an assets under management fee model, is more effective and ultimately probably more in keeping with our responsibility to give you the best advice. We've looked at it. Doesn't mean we won't ever do it, but we have to find a way to mitigate that that issue of the lack of the ongoing advice. As a matter of fact, if I remember correctly, and I don't have the paper in front of me, Vanguard's Advisor Alpha paper found that the additional return that you can expect from the hand-holding portion of an advisory relationship, a good one, is 1.5% per year, which is far less than we charge. Just that portion. So, no, we don't have an hourly fee, but thank you very much for listening, and thanks for the note. Now, let's see. The next one comes again from TalkingRealMoney.com. This is a 403B question. My daughter has just taken a job in higher education and will have a say in their 403B savings account. It currently uses TIA, and the consultant group is in Oregon, even though the school is in Washington. Any advice you can give her? Well, Tia Kreff is not bad. I don't know anything about the group in Oregon nor what they charge, but I really believe that the best choices that a 403B can offer are choices from someone like Vanguard, because of the very low fees and the great diversification, or dimensional funds if they're going to use an advisory firm. If she has a say in actually who is the what kind of investment products are in there, I always believe the more the merrier, that they should have Vanguard, that maybe she should ask that those be included in the program, just Vanguard index funds. But if you got Tia's okay. Thanks so much for that note. Again, send us a note at talkingrealmoney.com. Just hit the contact button. And here's our final question for today's short episode about investment portfolio under one roof. My wife and I have a little over $3 million in our investment portfolio. We are both right at 62 and not planning on taking Social Security for at least 3 or 4 years. Good. About half of our assets are in qualified accounts and half in our joint individual accounts. The overall mix is about 70% in equities and 30% in bonds and cash. Our portfolio spans 3 companies: Vanguard, TD Ameritrade, and PrimeCap Odyssey, with the bulk of our assets at Vanguard. My question is this. As my wife and I age, I feel it would be better to consolidate our portfolio to one institution, and that being Vanguard, which we've been with for many years. Then going forward, everything is under one roof, which could simplify things on my end. Does this sound reasonable? I love your podcast. Listen to everyone. Keep them coming, and more info on Social Security and Medicare could be topics for you guys, too. Well, that's a good idea, the Medicare. We talk about Social Security a lot. There's just not much you can say. The options are very limited with Social Security, but thank you. Yeah, we're big believers in consolidating accounts. Too many people, way too many investors, have what we call hodgepodge portfolios. A little bit of everything, a little bit of everywhere. They got accounts with the broker that they who cold called them back in 1982, and you got accounts with a 403B that you used to have, and an IRA over there, and a Roth over there, and regular accounts over here, and it's confusing and it's frustrating. That's why they should either, if you're going to use Vanguard, then you consolidated Vanguard. Absolutely. If you're using a TD Ameritrade, then you have issues because you're going to pay transaction fees to get Vanguard funds. So I'm with you on keeping it at Vanguard. I would only use Vanguard's index funds. Make your life even simpler. Use the Vanguard Total World Stock Index Fund combined with a short intermediate government fund or just the bond index fund. Simplify it even further. You don't want actively managed funds, and keep it all at Vanguard makes it easy. Just make sure you rebalance. Make sure you keep track of your risk tolerance and risk needs. Do not take more risk than your future needs require. If you have enough money to live comfortably going forward, don't be greedy. Don't have 70% in equities unless you know for a fact you are totally comfortable with a protracted decline, which could happen. We do not know the future. So, yeah, move to Vanguard. And again, if you have a question for us, well, for me, weekdays, call it in to 855-935-TALK, 855-935-8255. Just leave the question on the digital recorder, and then we'll work it into a future podcast. You can also go to TalkingRealMoney.com and just hit the contact button while you're at TalkingRealMoney.com. If you want to know a little bit more about Social Security income, there's a video there. If you want to know a little bit more about retirement income, there's a video there. If you want to know more about investing and how investing has changed over the years, because I'm a history buff, so there's a video there. And if you want to learn how to find the right kind of investment advisor, one who's going to look out for your best interests and invest based on science, there's a video there too, under the TalkingRealMoney.com/videos. There's also a link to set up an appointment with one of our advisors. And I promise you, see, the nice thing about you guys having me and Tom on the radio is the fact that if we don't tell you the truth, it's easy to call us on it. You can call the show and say, you told me there'd be no high-pressure sales pitch. Yeah, you could do that. But because I'm really confident you don't get a high-pressure sales pitch. See, we built our firm, which is called Vestory, to educate and to manage money. And we believe that by educating, we'll get more money management clients. And so far, that's been the way it's been. So check it all out, TalkingRealMoney.com. Also, subscribe to RealInvestingJournal.com. I've got a new one coming out in the next few days. And that's just an email newsletter. And let's see, what else should I tell you? I think that's about it. Thanks for listening. Subscribe to the podcast. Please tell your friends, your relatives, everyone you know that they should listen to this podcast. And thanks for listening. I'm Don McDonald.
Talking Real Money.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only.
Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times.
Also, as much as you want it, no one can accurately and consistently predict the future.
So past performance doesn't tell you a darn thing about what the future will bring.
Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities.
Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor.
Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures.
That should keep the lawyers happy.